Imagine a company that achieves this massive medical breakthrough, something people thought was, well, maybe years away. They get the first ever FDA approval for a T-cell therapy for a solid tumor. Sounds like a home run, right? A miracle, even.
Absolutely. A huge win for science, for patients.
And yet, just months later, the stock is, well, it's cratered, down over 80% from its peak. So the big question we're tackling today is, can this kind of truly revolutionary, life-saving science overcome what looks like a major crisis of confidence, operational missteps?
That's the heart of it, isn't it? Science versus execution.
That's exactly what we're diving into with Iovance Biotherapeutics. So today, it's a full deep dive into Iovance, ticker IOVA on NASDAQ. We're basing our analysis on its closing price of $1.87 on July 11th, 2025, so reflecting the market as of July 12th. We'll be looking at the incredible promise of their tech versus, well, the pretty harsh realities of their recent performance.
And the skepticism that's created, yeah.
There's a lot to unpack here. The science, the market's reaction. It's quite a story. First up, we'll lay out the core business, the management situation, and the financials. Before we properly jump in, though, just a quick reminder, please like and subscribe to the Stock Analytics AI YouTube channel. Members paying €4.99 a month get priority deep dives on tickers they request. And we are covering all the S&P 500 stocks over the next few months, so members get that priority access.
And if you just want a one-off deep dive on a specific stock, you can always drop us a super thanks on YouTube.
Exactly. Okay, let's kick things off with Chapter 1, Business Understanding. So Iovance really did something groundbreaking here. That first FDA approval for a T-cell therapy in a solid tumor advanced melanoma.
Right. It's not just a big deal medically. It's kind of a paradigm shift.
And their business model isn't straightforward, is it? They're not just selling a drug.
Not at all. It's a highly personalized service, really built around their cell therapy platform. It's intricate stuff. Starts with collecting a small tumor sample, maybe 1.5 centimeters, at these special authorized treatment centers, ATCs.
Okay.
Then that sample gets rushed to their own facility, the Iovance Cell Therapy Center, ICTC, in Philadelphia. It's a massive place, 136,000 square feet.
So it's genuinely custom-made medicine for each person. Sounds incredibly complex.
It is. At the ICTC, they use this proprietary 22-day process. They basically find the patient's own tumor-infiltrating lymphocytes, TILs, these are immune cells already in the tumor, and multiply them into billions.
Billions. Wow.
Billions. Then there's quality testing, cryopreservation. Finally, the patient gets immune suppression, then the Amtagvi infusion, and then a supportive drug called Proleukin.
Right, so Amtagvi is the main event, the core product. Revenue only counts when the patient actually gets the infusion.
Exactly.
And Proleukin is the necessary sidekick, providing some stable revenue. But the future growth, that's really about the pipeline, isn't it?
Oh, yeah. They're looking at other solid tumors, cervical, head and neck, non-small cell lung cancer, NSCLC. That's a big one. Plus next-gen TILs, genetically modified stuff.
And where do they sit in the market right now?
Well, for approved TIL therapy, they are the pioneer, the leader, no question. They've scaled up quite a bit, over 800 employees early this year. That ICTC, plus some contract manufacturing, gives them capacity for, several thousand patients a year, aiming for over 10,000 eventually.
So the core value proposition is hope, really. New hope for advanced cancer patients who've run out of options, personalized, potentially durable responses. It's cutting edge.
Absolutely. And that leads to the market potential. How big can this get? Projections are pretty wild. Key AGR, compound annual growth rate, maybe 25% to 40% for TIL therapy.
That's a huge growth.
It is.
Yeah.
The market size could go from maybe $300 million this year, 2025, to potentially $2 billion, maybe even $5 billion by the early 2030s.
What's driving that?
Well, unfortunately, increasing cancer rates, but also this big shift towards personalized medicine, tailored treatments.
Makes sense. But they can't be the only ones doing this. Competition.
Definitely not alone. Direct competitors, you've got companies like Instill Bio, Adaptimmune, other biotechs focused on T cells. But let's say the elephants in the room are the big pharma guys.
Yeah.
Gilead through Kite Pharma, Bristol Myers Squibb, Novartis.
Right. How does Iovance stand out from them?
The key thing was being first into solid tumors. The giants mostly focused on blood cancers with CAR-T therapy, which is, a different approach.
And getting this approved, the regulatory side must be.
Oh, incredibly tough. Arduous is the word. Iovance got lucky. Well, not lucky. They earned Fast Track and RMAT designations. Regenerative Medicine Advanced Therapy.
Which helps speed things up.
Exactly. But it's a double-edged sword. It keeps competitors out, sure.
Yeah.
But it also means continuous, intense scrutiny for Iovance's own pipeline drugs, high bar.
So what are the main barriers keeping others out?
Three big ones. First, the science itself. Decades of research, strong IP patents on Amtagvi out to at least 2042. That's a fortress.
Okay.
Second, manufacturing complexity. That one patient, one batch thing we talked about. It's a massive logistical, technical, and capital hurdle. Really hard to replicate.
And third,
Regulatory hurdles. That long, stringent FDA process.
so given all that, what are their actual competitive advantages now?
Well, their brand should be strong, pioneer status. But frankly, it's been tarnished by the recent commercial issues, the management questions.
Right. What about costs?
No advantage there yet. It's bespoke, so it actually has diseconomies of scale initially. Costs per patient are high. They target getting gross margins over 70%, but that depends entirely on achieving significant scale.
Any network effects, like
Yeah.
with the treatment centers?
Potentially with the ATCs.
Yeah.
But even that seems weakened by what the company itself called an ineffective sales team and slow treatment timelines. Makes it harder to lock centers in.
So the real edge comes down to,
They're unique assets. The FDA approval itself, that's a legal monopoly for Amtagvi in the U.S. for its indication. Their proprietary Gen 2 manufacturing. And the clinical data, including that impressive 5-year survival data, all backed by that strong IP.
okay, so the science is there, the approval is there, the manufacturing capability seems like a solid foundation. But here's where it gets really interesting, as you said, the execution. Let's move into chapter 2, management evaluation. This is where the story takes a sharp turn, right? The May 2025 crisis.
Exactly. This is crucial. The leadership, Frederick G. Vogt is interim CEO, president, general counsel. He's been there since 2021. So picture this. February 27th, 2025, they confidently reaffirmed their full-year revenue guidance.
Okay.
$450 to $475 million.
Okay, sounds good.
Then just 70 days later, May 8th, they slash it by almost 40%, down to $250 to $300 million.
70 days, wow. What was the explanation?
They blamed slow treatment timelines for new ATCs that the sales team was ineffective in patient identification, leading to high patient drop-off.
Yeah.
Basically, pointing fingers internally and externally.
Not a great look.
And it got worse. The COO, Igor Belinsky, later revealed a maintenance shutdown at the ICTC facility reduced capacity by 50% for a month. And apparently that impact was bigger than they initially let on.
So communication issues on top of operational ones. How did the market react?
Violently. Stock crashed 44% in a single day, dropped from $3.17 to $1.75. And, maybe unsurprisingly, multiple securities fraud class action lawsuits followed.
Ouch! Lawsuits
Alleging materially false and misleading statements. Essentially, that the company knew things were worse than they were saying when they reaffirmed that initial high guidance, concealing material adverse facts.
So the company claims to be ethical, honest, and transparent, but the lawsuits paint a very different picture.
Right, and then came the fallout.
The CFO exit.
Exactly. Jean-Marc Bellman, the CFO, resigned effective July 10th, right after this forecasting disaster. Hard to see that as a coincidence.
But they made a strategic hire around the same time, didn't they?
Yes, same day, July 10th. They appointed Dr. Mark Thierot. He's a 15-year FDA veteran, former Deputy Center Director at the Oncology Center of Excellence. Highly respected. Now he's Senior VP Regulatory Strategy.
Interesting move. Shoring up the science side.
Looks like it. A deliberate pivot, maybe, trying to shift focus from the messy present, the commercial problems, towards the pipeline, the regulatory future, putting a credible scientific face forward.
Makes sense strategically. Now, with all this going on, where are they putting their capital?
It's pretty typical for their stage. Focus is on R&D advancing the pipeline, especially NSCLC trials and SG&A, sales, general, admin, basically building that commercial infrastructure they admit needs work.
Any M&A? Buybacks? Dividends?
No significant M&A, just a minor clinic in there. Strategy is organic growth. And no buybacks or dividends, which is standard for pre-profit biotechs. They've explicitly said they'll retain earnings for expansion.
And the return on that invested capital, given the spending?
It's deeply negative. ROIC has been running anywhere from negative 46% to negative 80% on a trailing 12-month basis. Q1 2025 was around negative 54.6%.
So for every dollar invested, they're losing more than 50 cents currently.
Precisely. It highlights that this investment isn't just about the science working. It's a massive bet on management turning things around dramatically to actually generate a profit on all that capital someday.
Okay. So what does this all mean for the money side of things? Let's dive into Chapter 3, financial analysis.
Right, let's look at the numbers. The 5-year summary tells the story. 2020 to 2022, zero product revenue. Net losses piled up, $365 million in 2020, up to over $500 million in 2022. Cash burn followed suit, $240 million up to $400 million used in operations.
Then things started to change.
Tiny bit of revenue in 2023, $1.2 million, but still a huge loss, $444 million. 2024 was the first real commercial year, $164.1 million in revenue, still lost $372 million, burned $334 million in cash.
So revenue is appearing, but the losses are still massive.
Exactly. It shows the cost of building this out.
And the market cap reflects the recent turmoil, around $624 million as of July 12th. Down from what, $4 billion?
Yeah, a staggering drop from the 52-week high really puts the crisis in perspective.
Let's talk revenue growth trends. First commercial year, 2024, $164 million. Q1 2025 was $49.3 million, and the revised guidance for this year is $250–300 million.
Right, so the ramp is steep compared to zero, obviously. But the narrative changed completely. It's much flatter, much less certain than everyone expected just a few months ago.
And those profit margins, you mentioned the ROIC was bad. How are the operating margins looking?
They're abysmal right now. Gross margins low, 11–22% TTM, though they target over 70% with scale. That's the key.
Right.
But operating and net margins. Q1 2025, operating loss of $121 million on $49 million revenue. That's a negative 246% operating margin.
Yeah.
Net margin, negative 236%.
Minus 246%. So losing almost $2.50 for every $1 of revenue just on operations.
Yes. It just hammers home how much revenue growth they need just to break even, let alone become profitable. The scale required is enormous.
And free cash flow, still burning through cash rapidly.
Consistently and significantly. Q1 2025, they used $104 million in operations. Full year 2025 guidance is for under $300 million cash burn. It's that ticking clock idea. Getting to positive free cash flow depends entirely on that AMTAGV ramp-up. Every stumble pushes the timeline out, increases risk.
What about overall financial stability? Debt? Liquidity?
Earnings are consistently negative, expect losses to continue for a while. Debt to equity is basically zero echo. They funded through equity raises, which, highlights the dilution risk for current shareholders.
But they aren't about to go bankrupt tomorrow.
No, the current ratio is healthy at 4.18, so no immediate solvency crisis. The challenge is long-term profitability, and obviously no dividends planned.
So how is the market valuing this? If PE is meaningless, PS.
Right, we look at price to sales, trailing 12 months, it's around 2.9, maybe 2.84, according to Seeking Alpha.
How does that compare?
It's really low for this kind of biotech.
Right.
We looked at peers with similar market caps, Xencor at 5 times sales, Autolus at nearly 73 times, Merigkx at almost 18 times, Stoke Therapeutics closer at 3.6.
So IOV's 2.9 is definitely depressed.
Hugely. It screams market skepticism about their ability to hit future targets, given the recent stumbles.
Is there a way to estimate what it should be worth intrinsically, like a DCF?
We could try, but it's highly speculative for IOVA right now. A discounted cash flow model basically sums up estimated future cash flows, discounted back to today. But even building a conservative educational model, making some optimistic assumptions, you could maybe argue for a value range of, say, $4 to $8 per share.
Okay, that's quite a bit higher than the current $1.80. What are the big ifs in that calculation?
Huge ifs. You have to assume they hit the midpoint of this year's lowered guidance, $275 million. Then assume rapid growth on AMTAGV gaining share. New indications like NSCLC getting to $1.2 billion in revenue by 2029, 2031.
Big assumptions. And profitability.
Assume operating margins turn positive in, say, 3–4 years and ramp up towards mature biotech levels, helped by hitting that 70% gross margin target. And crucially, you have to use a very high discount rate, the WACC maybe 15% to 20%, because the risks are extraordinary. Clinical trial risk, execution risk, management credibility, future dilution.
So the bottom line on valuation is that any intrinsic value estimate relies heavily on a very optimistic future, heavily discounted for massive risk.
Exactly. The current price reflects the lack of confidence in that optimistic future playing out.
Okay, we've laid the groundwork for Iovance's business, management, and financials. Now let's turn our attention to what the broader market is saying and the inherent risks. We're moving into Chapter 4, market sentiment.
Right. So what are the analysts saying? Well, the formal consensus is still buy or moderate buy. About 82% rate, buy or strong buy.
That sounds positive.
On the surface, but dig deeper. The average 12-month price target ranges hugely, from about $11 to $15, depending on the source. But individual targets, they're all over the place, from $2 up to $26.
That's not consensus at all.
It's profound disagreement, really. And significantly, after that May guidance cut, several influential analysts, UBS, JMP, downgraded the stock. That's a clear signal of waning confidence from the experts.
And the general media tone.
Overwhelmingly negative lately. All the focus is on the stock crash, the lawsuits, the CFO resigning. The company's trying hard to counter with positive news, good 5-year survival data from Togvi, hiring Dr. Thierry from the FDA. But the market's narrative right now is dominated by the commercial failure and management credibility issues.
How is this reflected in market indicators? Short interest.
Exceptionally high, 34.5% of the float. That's over 96 million shares shorted.
Wow. What does that mean practically?
It means it's a classic battleground stock. The days to cover ratio is over 9. So huge potential for volatility. A positive surprise could trigger a massive short squeeze, sending the stock flying. More bad news and the shorts pile on.
And technicals. Moving averages.
Very bearish. The price, $1.87, is way below the 50-day moving average, which is around $2.44, $2.51. That signals strong negative momentum. And it's even further below the 200-day moving average, around $6.13, $6.27. That confirms a severe established downtrend. The charts look pretty ugly right now.
Now let's look at who owns this company and what their actions are telling us. Moving on to Chapter 5. Ownership structure.
Institutional ownership is really high, around 84%, mostly professional money managers.
Like who?
You've got the big index funds, Vanguard, BlackRock, but also specialized active funds like MHR Fund Management and Perceptive Advisors.
And Perceptive made a move recently?
Yeah, this is a cautionary signal. Perceptive Advisors, known for their biotech savvy, cut their position by 42%. That's a significant vote of no confidence from a supposedly smart money player.
But what about insiders? Are they selling too?
Here's where it gets interesting. Insider ownership numbers look a bit skewed because one director, Wayne Rothbaum, holds a massive stake, over 28 million shares. But the crucial data point is recent insider buying, specifically after the May crisis.
No.
The interim CEO, Frederick Vaughn, bought 25,000 shares. The chief regulatory officer, Raj Puri, bought 5,600. And the chief commercial officer, Daniel Kirby, bought 30,000 shares in early June.
So executives putting their own money in after the stock collapse?
Exactly. It's a powerful countersignal to the CFO leaving and Perceptive selling. A direct vote of confidence from the people running the show.
And ownership concentration. Still high.
Yes, significant concentration among those top institutional holders, which, again, just adds to the potential volatility. Big buys or sells from a few players can really move the needle.
This brings us to a crucial section, weighing the good against the bad. The future possibilities against the potential pitfalls. Let's explore Chapter 6, Risk Assessment, framed as a SWOT analysis. Strength, weaknesses, opportunities, threats.
Okay, strengths first. Core internal competencies. Number 1 is that first-mover FDA approval in solid tumor TIL therapy. Huge achievement. 2, validated science with strong clinical data, including that impressive 5-year survival data. 3, that fortress IP portfolio. Patents out to 2042. And 4, their in-house controlled manufacturing via the ICTC. Big plus.
Okay, now the weaknesses. Internal limitations. Top of the list has to be the severely damaged management credibility.
Absolutely. Tied to that is the demonstrated commercial execution failure.
Yeah.
They admitted it wasn't working well.
What else?
The high cash burn rate and finite financial runway, that ticking clock we mentioned, and high concentration on just Togvi right now.
Okay. Opportunities. Future market potential.
The big one is pipeline expansion into larger cancers, like NSCLC. That would be transformative. Entry into global markets. UK, EU, Canada applications are under review.
Yeah.
Developing next-gen TILs. And, maybe ironically, their depressed value could make them an attractive acquisition target.
And finally, threats. General external challenges. Competition has to be high on that list.
Definitely. Intense competition from peers and the pharma giants. There's also the significant litigation overhang from those shareholder lawsuits.
Capital risk.
Yes, capital markets risk. Likelihood of future dilution if they need more cash. And ongoing reimbursement and market access hurdles for a very expensive therapy.
Any macro factors? Interest rates, geopolitics.
High interest rates are a direct threat. Makes capital more expensive, increases the discount rate used in valuation. Geopolitically, their U.S.-based manufacturing is actually a plus, insulating them somewhat from supply chain or tariff risks.
We've journeyed through the intricate details, the science, the financials, the drama. Now it's time to bring it all together. This is Chapter 7, Conclusion.
Okay, let's summarize the bull case. Why might you invest? 1, pioneering science. Leader in a revolutionary cancer therapy. Big head start. 2, vast market opportunity. Billions in potential market size. Phenomenal projected growth. 3, massive pipeline potential. Current value arguably ignores the pipeline. Success in NSCLC would be a game changer.
Plus the insider buying.
Right. 4. Insider conviction and deep-pocketed backing. Executive buying post-crisis, key director with a huge stake. And 5. Deeply depressed valuation. Stock is crushed, arguably prices in the worst case, creating asymmetric risk-reward potential.
Okay, now the bear case. Why stay away? 1. Broken trust and credibility. Management's word is, frankly, questionable after the guidance fiasco. 2. Demonstrated incompetence. The commercial launch failed by their own admission, questioning their ability to scale.
3. Precarious financials. High cash burn creates that ticking clock. Risk of highly dilutive financing is real. 4. Overwhelmingly negative sentiment. The market is betting against them. High short interest, bearish technicals.
And the intrinsic value range again?
Based on that speculative DCF, maybe $4 to $8 per share. But again, highly speculative, not a prediction, just a framework based on optimistic assumptions.
So the concluding outlook, the current share price, $1.87 as of July 12, 2025, is way below even risk-adjusted estimates. The market clearly reflects a profound crisis of confidence. It's pricing in a high probability of failure. So an investment in IOVA today, it feels less like a bet on the science because that seems largely validated, right? It's more a bet on a management turnaround.
That's exactly it. Can this team, or a potentially new team, execute?
It's high risk, high reward. Requires execution to unlock any potential upside. Simple as that. So, as you consider Iovance, maybe remember this. That intersection of amazing science and the often messy, difficult reality of commercial execution, that's usually where success or failure is decided. For a company like Iovance, the question isn't just, can the science save lives? It clearly can. It's, can the leadership navigate the market to actually deliver that science effectively? What stands out to you as the most critical factor for their future? Something to think about.
Okay, that concludes our deep dive for today. Don't forget to like and subscribe to the Stock Analytics AI YouTube channel. Members get priority access to deep dives, especially in the S&P 500 stocks we're covering. $4.99 a month.
Or drop a super thanks if you want a specific one-off deep dive. Yeah. And finally, the important reminder. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be taken as financial advice.
Please do your own research, or better yet, talk to a qualified financial advisor before making any investment decisions.